Hey, this is Phil from the Next Chapter team. Welcome to another article review. Today's article review is going to focus on 4 banking mistakes that you want to avoid if you want to keep your money growing in a safe manner, just like the wealth. Before we jump into the review, please take a moment to like, subscribe, and share. Help the channel grow. Now, sit back, relax, and enjoy another article review from the Next Chapter team. First and foremost, the mistake to avoid is not diversifying your money between financial institutions or banks. Why is this so important? One, you don't want to keep all your money in one basket. You want to spread your money around when it makes sense. Now, the article calls out the importance of taking advantage of these financial institutions. So a good rule of thumb is if you can separate your money into categories that make sense because you have enough money to meet the minimum requirements, as well as take advantage of special interest rates over the long term or even CDs, this can help you. So for example, what you can do, you can have different banks to take advantage of higher interest rates, reduced fees, and even investment opportunities to help your money grow over the long term securely. Now, a good prime example of this is, for example, you could keep your 6-month savings in one institution, and then have money that you're saving up for vacation or even a car, or even like your first home in another financial institution. And that other financial institution, for example, may have attractive interest rates on certificates of deposit, CDs, that if you lock it up for 1 year, it'll be a higher interest rate than just in your high yield savings account. So again, that's a nice simple example of taking advantage of diversifying your money between more than one bank, more than one financial institution. So again, avoid this mistake. When it makes sense, when you reach that financial point where it makes sense, diversifying your money between financial institutions is a great mistake that you want to avoid. You want to make sure you have your money spread out to make sure it's working as hard as possible. As after all, your savings can work for you, as well as of course money that you're saving up to do big purchases. Have that money working for you. High yield savings accounts, CDs, money market accounts, great ways to have the money grow safe and secure. But they're saying avoid the mistake of not diversifying your money. Don't have it in one big pile when you could have in 2 or 3 medium-sized piles, but they're growing at different interest rates. They can have better terms that are better for you. And you got to read those terms and make sure that they're better for you. The second mistake that you want to avoid is ignoring fee structure. It is really important. We talk about terms in the first tip. The second one is fee structure. It's really important to know the fees associated with your account and understand them to make sure that you can operate in a way that you avoid those fees, or if you can't avoid those fees, maybe that's not the right account for you. That's right, not all accounts are for you. You should really be striving to have your money in a savings account or even a checking account that is growing, or you're just utilizing it in a way that you don't have to pay fees. Avoid those fees, because you know what? Over time, it adds up. It's just chipping away at your ability to either pay down debts or even invest. So the number 2 mistake to avoid is ignoring those fees. You've got to look at the fee structure for your accounts, take advantage of them, maximize, and do not lose money to fees. The banks make enough money on loans and other products. Don't give them your fee money. The third thing that you want to avoid, the third mistake, is neglecting or not focusing on interest rates. This is really important. It's a great call out here is to understand the interest rates on these accounts. Take advantage of them where appropriate. Understand that between those different institutions. Tip number 1, the interest rates are going to be different. So really paying attention to interest rate is critical because, again, this is your money that you're going to use anywhere between 1 year and 5 years. So you don't want it in the market because you don't want the money to be going up and down in value as markets tend to go. So you want to make sure that in the banking front, this money in high yield savings accounts or even money market accounts or even CDs, certificates of deposit, are growing to the best of the ability that you can. And the only way to do that is to pay attention to all those fees and interest rates. Really, it's important. Number 3, do not neglect interest rates. Pay attention to it so you can make sure your money is working as hard as possible between the financial institutions, the banks, or the investment companies that you have money in. Pay attention to your options that you have available to you and maximize them. Just read them over every month or so, or every 2 months. They don't change very frequently, to be very honest with you. And when they do change, guess what? Banks are required to send you notifications. So read your notifications, read the opportunities, and take advantage of them and have your money growing to the best of the ability in those accounts. The fourth and final tip is you don't want to avoid overlooking digital tools and digital banking tools. And what they're saying here is it is amazing what you could just see right on your phone and take the time to do it. And if you have an account that's very active, look at it very actively. You could see on your phone or mobile device or any platform really, or even an iPad or whatever, you can see your account balance real time. You can make automated bill payments. You can do online transfers between accounts at the same financial institution, and you can even initiate transfers from one bank to the other, one financial institution to the other. But again, pay attention to those fees, right? And by doing this, by paying attention to your accounts, using these digital tools, guess what else you're doing? You're avoiding the possibility of having an over withdrawn account. And then again, when you have over withdrawn account, you're going to have more fees. So avoid those fees. Use your tools. So again, use those tools. Take advantage of these tools. They are much better than they used to be. And I hope you enjoyed the review. Okay, now just a quick recap. Again, 4 banking mistakes to avoid that rich people and people building wealth are making sure that they do to help build wealth. Number 1, not diversifying your between financial institutions. Again, what does this mean? Not having all your money in one spot. So it's important to avoid the mistake of having all your money in one spot when it makes sense, and instead take advantage of different financial institutions to help your money grow consistently. Number 2, ignoring fee structures. This is crazy. You don't want to ignore the fee structures. You don't want to be paying fees every month when you could avoid it by maintaining the right balance or even making sure you have the right category of account. This is just nuts. All right, number 3, neglecting interest rates. This is really important. If you understand your fee structure, you also should take a moment to understand the interest rates. Understand the interest rates you have available to you between your financial accounts, your bank accounts, as well as your financial institution accounts, your investing accounts. Sometimes investment institutions have attractive rates as well. So take advantage of it when it makes sense. And number 4, finally, do not overlook the digital banking tools. There are so many great tools out there with banks nowadays, whether it be on the website or even on a phone. You could put notifications when you have a low balance. You could do many, many things to help you avoid fees. So taking advantage of all 4 of these, avoid these 4 mistakes will help you preserve your money and over the long term help your money grow and keep that extra money. You can invest it or live life and enjoy it. Hope you enjoyed the review. So many more to come. See you in the next one.
Hey, thanks for staying to the end. This video is brought to you by the Next Chapter team. If you enjoyed the video, please take a moment to hit that like button, drop a comment, subscribe, share with your friends and family. This will help the channel reach out to more individuals just like you. We offer one-on-one coaching where we work with people and small businesses to determine a clear path to achieving their financial goals. This includes things like budgeting to reduce debts, planning for big purchases, and even learning how to build wealth with the tools that you have readily available to you. So please see our link below to schedule a free 30-minute call with our team to talk through coaching and understanding your current financial situation. Also, check out some of our affiliate links below for our high yield savings account. This is a great place to put your money when you're saving up for those big purchases and your emergency fund. Check out some of our videos right here. And please enjoy and see you in the next video.